I've had numerous subscribers ask me recently whether or not I think it's too late to buy gold, or whether or not it's too expensive right now because of its recent run-up in price from $1,200 per ounce a couple of years ago to its current level of about $1,700 per ounce. I've always felt a little bit bad that I couldn't provide clear guidance for everyone. After all, everyone's situation is different, and without knowing a person's personal situation, it's very difficult to answer the question. So the goal of this video is to provide seasoned veterans and newcomers alike to the metals community some information that can serve to guide the decision-making process. Let's start with this chart. It represents how those Federal Reserve notes that you keep in your pocket compare against gold from the standpoint of the past 50 years of history. As I've said in the past, confidence in currencies waxes and wanes depending upon many factors, from how strong the economy is, to how widely used the currency is in world commerce, to how indebted the issuing country is. And this chart shows that. It is the ratio of U.S. currency in circulation to the marked-to-market value of U.S. gold held by the Treasury. The ratio has fluctuated around an average value of 3.8 and currently stands at 4.2. So one could conclude that despite gold's recent rise in price, the Federal Reserve note is still 10% stronger against gold than it has been in the past 50 years on average. And this should be comforting to someone buying gold. But look at that range. Confidence sure can vary widely. At the peak of confidence in the U.S. in early 2001, the ratio peaked out at close to 9-1. So if confidence in the U.S. strengthens once again to early 2001 levels, we could potentially see the real value of gold fall against the dollar to a price as low as $875 per ounce. Do I think this is likely? No, I don't. But I will admit that this is a possibility. On the other hand, we need to acknowledge that the reason to hold gold is to guard against loss of confidence in paper. In 1980, when confidence in the Federal Reserve note was at a very low point, the ratio of currency in circulation to Treasury-held gold hit a value of 1-1. The U.S. at the time could have completely backed the currency in circulation with gold that it had in its possession. If such a loss of confidence were to happen again, the price of gold would reach about $13,000 per ounce. This is mind-boggling for most people, but given the expansion in the currency supply since 1980, this is certainly in the realm of possibilities. Heck, even if confidence in the Federal Reserve notes hits the same level as in 2011, gold would be priced at $3,000 per ounce. Yes, that's right. Due to currency expansion, the old high of about $1,900 per ounce would need to be more than 50% higher. Of course, all of this is based upon currency in circulation staying stagnant. Recently, it's been expanding at a rate of close to 15% per year on an annualized basis. So the longer we wait, the higher the price targets would have to be, both on the low side and on the high side. But what good is it to give you predictions that have such a large range? How can anyone make a decision to spend $1,800 to $1,900 for an ounce of gold today if they don't know whether it will be worth $3,000 in a few years, $13,000 in a few years, or $875 in a few years? The answer is that this is the wrong way of thinking about gold. Gold is not something that you buy to make a paper currency profit. After all, in the case where gold's price is rocketing in a particular currency, it's a hint that something may be wrong with that currency. Jumping out to take a profit may be the wrong thing to do. Let's look at gold another way. Let's look at it from the standpoint of it being insurance against something going very, very wrong. Here is a chart I put together showing rolling 10-year inflation-adjusted returns of stocks and bonds against gold. The 10-year real rate of return on gold is on the horizontal axis. Each corresponding total real return of the S&P 500, including reinvested dividends, is shown as a blue dot, and each total real return of the 10-year Treasury is shown as a red dot. Immediately, we can see a few important things. Contrary to what most financial experts state, bond and stock returns are correlated over the long term. When bonds do well over a 10-year time frame, stocks tend to do well over a 10-year time frame. When bonds do poorly over a 10-year time frame, stocks also tend to do poorly over a 10-year time frame. So bonds are not a great way of hedging stock market risk, at least not long term. But gold, on the other hand, tends to move in opposite directions to stocks and bonds. Gold tends to do well over the long term when financial assets do poorly, and gold tends to do poorly when financial assets perform well. Hence the negative slope on the trend lines through both sets of data. And why is this important? The answer is that we live in an uncertain world. I have my well-educated guesses about what the price of gold is going to be in the future, but so do a lot of other smart people. And we're all placing our bets against each other. The same thing goes for stocks and bonds. I have my educated guesses about how stocks and bonds are going to do, and there are many other people who agree with me, but also many other people who are willing to take the opposite side of the bet. And that's what makes a market. So the value of the information on this chart is that you can use gold and the fact that it tends to move opposite of financial assets to guard against uncertainty. On the flip side, it also suggests that you can add some financial assets to your portfolio to protect yourself against an undesirable and unforeseen outcome in gold. So how much gold are we talking about? What is sufficient to guard against a calamity in paper assets? I've been asked this question numerous times. With a little bit of algebra and a little bit of calculus, we can calculate the mixture of gold with bonds and the mixture of gold with stocks that minimizes the variability of the combined portfolio. You'll be happy to know that I'm not going to cover the math involved to arrive at this result. The result is what will matter to most people. What we can determine is that if a portfolio consists of just gold and bonds, 20% gold will protect the portfolio, meaning that even if bond returns have a horrible outcome due to high inflation, the real return on gold will make up for the value lost in the paper. A 35% gold position will protect in an all gold and stock portfolio. The actual number of gold is close to 34%, but I'm rounding to the nearest multiple of 5%. I'll show you how this 35-65% mixture of gold and stocks fared over the past 50 years relative to just stock, bond, and gold in a moment. But first, I'd also like to show you how this information here can be used to arrive at another educated guess about gold's likely future performance. While it's very difficult to determine how well stocks are likely to perform in real inflation-adjusted terms in the future, it's easier to see how well bonds are likely to perform. One thing that we know for certain right now is that the 10-year Treasury Inflation Protected Bond, or TIPS, has a real yield of negative 0.45%. Admittedly, this is a horrible rate of return. Investors are willing to buy 10-year TIPS and guarantee themselves close to 0.5% loss in purchasing power every year. We can surmise that this means that investors are anticipating a similar return on nominal 10-year bonds. After all, if they thought that nominal bonds would perform better, then they'd buy those instead of the TIPS. If they thought they'd perform worse, then they'd just buy the TIPS. Assuming a negative 0.5% real return on bonds going forward, we can trace a line over to the bond line regression and see that for this horrible real rate of return seen on bonds in the past, gold has performed at a 18% per year real rate of return. If this comes to pass, it suggests a real gold price of over $9,000 per ounce. Coincidentally, this is somewhere between where the currency and circulation analysis suggested gold would be if confidence is lost to close to 1980 levels. Coincidence? Maybe. You'll have to be the judge. Am I suggesting that a person go all in on gold to reap these rewards? No, not at all. As I said, using gold to generate a dollar profit is not the right way to think about gold. Let's see what's happened in the past when gold has been used as a guard against calamity in paper. If a hypothetical investor had an amount of money to spend in 1968 that would be the equivalent to $100 in today's dollars, and could pick any vehicle in which to save her money, whether it be stocks, bonds, gold, or a mixture of the three, what would she have been best off choosing if she was going to hold until the year 2020? Most people would say stocks with the benefit of hindsight, but this would have been wrong. We can see from the black line that stocks did do very well, turning $100 in today's purchasing power into $1,700 at the end of the 5-decade period. But look at how variable the performance was over that period of time. What would have happened if she had to withdraw some funds in 1974 or in 1982? It would have severely hurt her long-term performance. How about rock-solid bonds as shown in green? Most people think that bonds are the most conservative investment. Not so, according to this. Bonds were actually less safe than stocks over the decade of the inflationary 1970s. To make matters worse, due to the lower returns bonds offered relative to stocks, the investor only had $490 in real purchasing power at the end of 5 decades. This is a pretty poor showing and doesn't even include the punishing impact of taxes. Now, most investment professionals, and I'm making air quotes here with my fingers when I say professionals because of their over-reliance on paper assets, would say that it's foolish to hold only stocks or only bonds. The tried and true financial portfolio is a mix of 60% stocks and 40% bonds. Okay, fair enough. I've put that on this plot as the red line. At the end, our investor managed to increase their $100 seed money to $1,200 worth of purchasing power over this 5-decade period. Did the bonds smooth out the ride? Only over very short periods of time. Notice that bonds did not protect against poor performance of stocks in the 1970s. So we can see now that the story we're told that bonds hedge against stock losses is false. Enter gold, shown in yellow. Gold actually outperformed bonds over the 5-decade period, and the investor did not have to pay taxes until the very end. But look at that volatility. It was absolutely great to have in the 1970s and 2000s, but it was actually horrible to own in the 1980s and 1990s. If our gold buyer knew ahead of time the good times to own gold and the good times to own paper, that would have been fantastic. I'm a little leery of anyone who says that they can make such predictions reliably. But look what happens when you mix 35% gold with 65% stocks. This is shown in another curve here in blue. Over the long term, this mix increased purchasing power just as effectively as a pure stock portfolio, but it did so with much greater predictability. In every 10-year time period, it performed quite well. There really was no need to guess at whether gold or stocks were overvalued or undervalued, and I think that is the key, especially for somebody who's concerned about getting the gold price right. So for all of my subscribers who are asking me whether it's too late to buy gold now or if gold is fairly priced, I will say this. If you own paper assets, such as stocks and bonds, and less than 20% of your wealth is in gold, then you will be subject to considerable risk of being wrong on the performance of your paper assets. If more than 35% of your wealth is in gold, then you need to be concerned about getting the gold valuation question right or risk being hurt in the long run. Now, tomorrow I will discuss my own personal allocation. I will do this in the interest of full disclosure, but none of this should be considered investment advice. This is only for informational purposes. I've had numerous subscribers ask me recently whether or not